It's time for some more hot topics. Don't forget to subscribe, like the video, tell your friends and family to do the same. It's Sunday, the 3rd of November, a couple of days away from the election. Thought we'd check in on the economy and a little snapshot of markets. Checking economic data released this past week, last Monday through this past Friday. Little glimpse into what's ahead this week. I'll tell you what, if you're a Democrat, you're happy where the economy is right now as we approach election day, even though tens of millions of votes have already been cast, and the majority of votes will probably cast early. Nonetheless, we still have Tuesday, election day. And this is pretty much where you want your economy to be going into election day. Obviously, there's some serious negatives that are economic on people's minds, the impacts of mass illegal immigration, the price level being up over 20% in 4 years, a lot of part-time jobs, not many full-time jobs, tough making ends meet. But just from an empirical perspective, not bad, the data from the past week, checking at September and October for the performance of the U.S. economy. We'll start this past Tuesday, no data on the Monday. Tuesday, we had the September goods trade balance, another whopper, minus $108 billion trade deficit for the month of September, mostly with China, 35-40% of that with China. This guarantees our 2024 trade deficit in goods will be over $1.1 trillion, a monster number. This was worse than expected of $96 billion and worse than the prior month of August of $94 billion. Same old when it comes to trade. We have to change our trade policy. Trump is right on this. Also, last Tuesday, we had the Conference Board Consumer Confidence Index. Big number, way above expectations. A big sigma beat here, 108.7 versus 99.5 expected and 99.2 in the prior month. Huge number, the Conference Board. Strongest monthly gain since March of 2021. All 5 components of the index improved. Consumers' assessment of current business conditions turned positive. Views on current availability of jobs rebounded. Consumers are substantially more optimistic about the future business conditions. And they showed cautious optimism about the future job availability. So good news there, although the index is still well below where we were in January 2020, when the index was in the 130 range. So we're still in the somewhat of an expansionary range, but not strong, though a good number. On Wednesday, we had the ADP employment report. Private sector job growth of the economy, ADP, the private check writing company. Net private sector job growth, 233,000 for the month of October, expecting 110,000 against 159,000 in September. So a good number here. Again, does not include government employment. Not much of a leading indicator for the non-farm payroll report that comes from the employment situation report, which is released every Friday after this, which we'll talk about in a second. Also on Wednesday, we had the first look at GDP for the third quarter. Preliminary GDP came out 2.8%, nice number. The GDP price index, the deflator, 1.8%, good number, below 2%. The core index, excluding food and energy, 2.2%, a little concerning there. But a nice number here, slow growth, not bad. Not surprising, this boost in GDP is largely driven by federal government spending, but overall government spending, including state and local government spending. So not ideally what we want pushing the economy. Consumption was up small. Business fixed investment up tiny. Government spending up over 5%. Net exports negative, of course, as always. Exports up 11% and imports up 16%. Nonetheless, based on what we usually look at, a decent number. Also on Wednesday, we had pending home sales for September. Those homes in contract waiting to go to closing. Up 7.4%, good number there, way above expectations, way above the data for August. So really good news there. Those are homes in contract waiting to go to closing, and a robust number across the country. Thursday, as always, initial unemployment claims for the week ending the 26th of October, 216,000. Happy days, great number. Better than expected, better than the prior week. I've said this for some time. I'm a little concerned about this data. Something's wrong in this data series, the claims data. I think we might have some weather impacts here on jobs we get on Thursday and Friday. The headline number is still a good number. Also on Thursday, Chicago Purchasing Managers Index for the month of October, week number 41.6, worse than expected 46.9, and worse than the prior month 46.6. This number has been weak for some time, below 50 is contractionary. Then lastly, on Friday, the mother of all data reports, we get the employment situation report from the Bureau of Labor Statistics. Headline number in that series is the non-farm payroll data, private sector and government job creation on a net basis for the month of October. 12,000, weak, way below expectations of 165 and way below the prior month. Could be weather related, hurricanes and strikes at Boeing. We'll have to see another month or two ahead to see how this shakes out, but a weak number for sure. Average hourly earnings up 0.4%, higher than expected, higher than the prior month, and year over year up 4%. This will spook the Fed. The U3 unemployment rate, the narrow measure of unemployment rate, the headline number that the media uses, 4.1%, unchanged from the prior month. The U6 rate, the broadest measure, the best measure, includes discouraged workers, 7.7%, unchanged for the prior month. And then lastly, on Friday, we had the September construction spending up 0.1%, a little better than expected, about the same as the prior month. So overall, not a bad batch of data. If you're incumbents at any level of governance, you're happy with this level of economic activity as we approach an election here. Gas prices are not bad, above where we were in 2020, but not bad, below the highs in 2022. So you'd be relatively happy. We still have a price level problem. We still have an inflationary problem. I do want to quibble again with the media. The media has been portraying the economic outlook as good, and it has been good and helpful for Joe Biden and Kamala Harris and Democrats. They've been trying to claim, though, again, that President Biden and Kamala Harris deserve credit for the drop in inflation rates since 2022, the peak of 9%. It simply is not true. They have done nothing but the opposite in every way from helping reduce the rates of inflation. The cause for the drop in the rates of inflation are Federal Reserve monetary policy, increasing interest rates from basically 0 to 5.5%, and change in consumption habits by households and businesses across the country. Reduced pressure on oil prices out of the Middle East and Russia and Ukraine, and overall general slowdown in economic activity. Nothing the Biden-Harris team has done has helped reduce inflation. They have done the opposite. Everything Democrats are doing is working against the Fed, against what you and I are doing, and keeping upward pressure on prices. Nonetheless, not a bad state of the economy right now. Checking on the employment data, of course, we still run and remind ourselves we still have the same challenges. Most of the jobs being created are part-time jobs. More Americans than ever working multiple part-time jobs. More jobs going to foreign-born workers and native-born workers. You can see this when you go to BLS.gov, Bureau of Labor Statistics. Go to the headline for job creation, scroll down for their tables, and you can see table A7, table A8, table A15, and get these details. So this week coming up, Wednesday and Thursday, the Federal Reserve Federal Open Market Committee meets for a two-day meeting to set interest rate policy. Expectations are they might drop another 25 basis points. I urge the Fed to stay on hold. Do not drop interest rates again. They have had a problem since their last rate cut in September. They cut 50 basis points in September, the federal funds rate, interest on reserves, the discount rate. And the U.S. 10-year is well above where it was in September. Concerns about inflation remain. You can see this in interest rates, gold, cryptocurrencies. Anyway, ahead of the Fed meeting, S&P 500 trading 5,728, not far off all-time highs, above 5,850. Can't keep a good market down. Still a buy the dip market. The U.S. 10-year Again, trading at a low of 360 in September after the Fed rate cut, now trading at 4.36%. They're not buying the Fed's outlook on inflation, that's for sure. Closed the week at the high. Take a look at oil, West Texas Intermediate, the NYMEX crude, 69.49. Tensions in the Middle East, ongoing war in Ukraine, Russia, doing nothing to disrupt in any serious way oil prices. The Biden administration has handled the Middle East war, Israel, Palestine, Gaza, Hamas, Iran, the Houthi rebels, Hezbollah, reasonably well in terms of oil prices. They've kept Israel from striking Iran's oil infrastructure, and that has certainly helped. And the world has come to be comfortable with the flows of oil and natural gas out of the Russia-Ukraine region. And so not bad news there. Gas prices in the Northeast not too high. Nice just before ahead of an election. Checking on gold, trading 2,749, off all-time highs about 2,800. I think this is a little overdone. Remember, when I think about selling rallies here in gold, obviously the gold market is signaling uncertainty and concerns about inflation remain, or now we're just being driven by pure speculation as gold continues to make all-time highs. Hard to discern until it's over. Could be a little bubble here building in gold. Dollar index trading above 104. Well off the lows set in September on the back of the Fed rate cut. Down near 100. Dollar still relatively strong against euro and the yen, British pound sterling. Look for resistance up here at the 104.30 level. Watch for a sell-off in the dollar on the back of any Fed rate decisions on Wednesday and Thursday. Should be already priced in, but markets are reacting to these things anyway. So a couple days ahead of an election, not bad. An economy that's not bad. Obviously, as I pointed out at the start, the rise in the price level since January 2021 is still a real issue for Americans. Americans are really struggling when it comes to inflation. The rate of change in the index, the consumer price index, still is positive, but the second derivative is negative. It's rising at a decreasing rate, approaching 2% on an annualized basis. Good news to be sure. But just because rates of inflation are falling doesn't mean price level is falling. Price level is still rising, just rising at a slower level and still over 20% higher than it was in January 2021. So this is something Americans still feel across the board in pretty much every consumer sector that we have. All right, a quick check of the week ahead. The week after the employment situation report, pretty quiet week on the data calendar. Factory orders on Monday for September. Looking for down small in factory orders. On Tuesday, we have the presidential election. Big news, of course. The goods and services trade balance for September, looking for down 75 billion, another trade deficit. On Wednesday, the two-day Fed meeting begins with an interest rate decision Thursday afternoon at 2 p.m. As always, on Wednesdays, MBA mortgage applications for the week ending the 2nd. Thursday, initial jobless claims for the week ending the 2nd. Q3 non-farm productivity, Q3 unit labor costs. Hopefully the Fed will have that information in hand before they make their interest rate decision. Friday, University of Michigan Consumer Sentiment Index for November. And that's about it for market moving data for the week. Obviously, pay attention to election headlines. When it comes to stock markets, I don't think we're going to see much difference with respect to Harris and Trump in terms of reactions. I think President Trump's economic policies are more pro-growth than Kamala Harris's. Kamala Harris has some tax increase proposals that are going to spook markets, but haven't yet. We'll see how markets respond. She is talking about putting a tax on unrealized capital gains. If it looks like she's going to win the election, that will spook markets to be sure. But neither candidate is talking about any real significant cuts in spending, although possible Trump appointees are talking about possible cuts in government spending. So I think it's almost a wash when it comes to economics and impacts on stock market between the two in the early days after the election. Remember, we won't know the outcome on Tuesday unless it's a landslide for either side. So patience, going to see a lot of legal wrangling, potentially some protests. Get out and vote, though. It's a wonderful day. It's a wonderful activity. It's a feel-good thing to do. Be sure to get out and vote on Tuesday for whoever you support. It seems like Trump is likely the better candidate for the U.S. economy, for growth, for national security. It seems that way as well. I'll leave that to you to decide, of course. All right, that's all I have for you right now. Always try to buy American.